Owen, Head of Group Communications. Today I'm joined by Dr Scott Osborne, our Chief Investment Officer, Toby Hulse, Investment Analyst, and Nathan Chan, Senior Investment Analyst. And we're gathered today because the VT Astute funds have reached their 3rd anniversary. So Scott, if I could turn to you first, it's been a strange 3 years, hasn't it?
Yeah, strange is one way of describing it, I suppose. I guess if we go back 3 years or a little bit more to when I started, and I was, sat there in my slippers and my dressing gown because we were still in lockdown. If you told me everything that was going to happen over the next 3 years, then I might not have even taken the job. Yeah, so it has been a rollercoaster ride when you consider everything that's happened in the past 3 years. Where, as I alluded to there, we started in a pandemic. Obviously brand new, people changing habits, huge macro trends changing around people. And then we had all the consequences of that coming through. As we now know, inflation has been the big topic with central banks raising rates the fastest pace basically in modern history, to previous cycle highs as well, where we sit today in north of 5%. And then you throw in all these sort of, I don't want to say that they're smaller things because these, that's been the big macro theme, but all the little bits, elections, politics, the Russian invasion of Ukraine, clearly another huge risk factor that we had to consider. And then there's the dynamics within the markets as well. We've had last year the worst year for bonds, again in living memory basically, and we've had to navigate through all of those potential pitfalls. So again, if you told me all of that, I probably wouldn't have been that keen to take the job, but actually looking at where we've been, I think we've actually done a pretty good job. Positive returns on all 3 funds, ahead or in line of our peers, not that we worry about that too much. So it's a sort of bittersweet. I think we're actually pretty positive about how we've done, particularly on the lower risk profiles, where the real big landmine to avoid was this bond crisis. So yeah, actually, again, with hindsight, it's a wonderful thing. If you told me this is where we'd be, I probably, in the context of everything that's happened in those 3 years, I think I probably would have been pretty pleased. That doesn't mean it's it's a perfect scorecard by any means, or that it's been easy, because it's been, like I say, it's been pretty much the most difficult period for asset markets generally, and certainly in my career in asset management.
Brilliant. And Toby, what have you found most challenging about the last 3 years?
Yeah, I think 2022 stands out as the most challenging period for me. We saw Russia invade Ukraine, and investors sort of started to worry then about the impacts that would have on inflation, interest rate rises, and eventually the increased likelihood of a global recession. That, in conjunction with the pace and the scale of interest rate rises we saw over the period, was just made a bad dynamic for that sort of slowing growth environment in conjunction with a rise in rate environment, and that was a sort of perfect storm for bond and equity prices. And actually in equity markets, it was reasonably typical for the events that we saw over the year. What was exceptional was fixed income markets. They sold off quite heavily, and in risk-free assets, for example, government bonds it was one of the worst years in history. So we essentially had a typical equity bear market, but it coincided with quite an atypical bond bear market. And the problem with that in a multi-asset portfolio is, as correlation between bond returns and equity return increases, it sort of starts to undermine the benefits of portfolio diversification, especially at a time when inflation was so rampant and working so hard to erode the sort of real value of assets. And as an analyst, you're constantly reviewing the holdings in the portfolio, and with equities and bonds out of favour, it sort of left fewer options to generate returns and less levers to pull. And the way we managed that in the funds was in the fixed income buckets, we looked outside of developed markets. So we introduced Chinese government bonds actually at the end of 2021, but we increased the allocation in 2022, and that reduced sensitivity to interest rates, and it offered us some good protection through 2022 in our fixed income buckets. In our alternatives, our equity market neutral funds also offered us some great protection and performed how we would want them to in that environment. And in our equity portion of the portfolio, we introduced 2 new infrastructure names, and the investment case for those were that regardless of economic outlook, recession risk, interest rate rises, critical infrastructure is always needed, and we also like the added benefit of the clean energy transition. So it was a challenging year, but it was enjoyable to work through those problems and come up with some solutions.
Brilliant, thank you. And Nathan, what about you?
Yeah, so I think for me, I really want to expand on a point that Scott wrote about in our quarterly investment update about, really building that discipline to choose which balls to hit and which ones to leave, because that decision-making process is ultimately driven by the belief in your own research and conviction, which, during times when markets are as tough as they've been, it's, obviously clearly easier said than done. For example, if we take a trip back to March, everyone by now will be aware of the mini banking crisis that saw the failure of several high-profile banks in the US, which obviously resulted in a significant increase in volatility, given that there were fears at the time that it was going to become something a little bit more systemic. And that eventually dragged down banks outside of the US as well, particularly, Credit Suisse in Europe. Now, luckily for us, in January, we had already completed some in-depth research on the European banking sector because of our plans to buy a fixed income manager who invests in bank debt. So we already had the data that we needed, plus the opinions from actual bank specialists to be confident that European banks shouldn't really be affected by this overall, but probably some short-term volatility, because underlying fundamentals for banks have improved significantly since the financial crisis, and banks are now well capitalized to deal with any exogenous shocks. Of course, for the team, it's always challenging trying to maintain that confidence to believe in your own research, particularly when bank stocks have already fallen by 10 to 15% in a short period of time, and still falling at that point, to try and go ahead and put a position together in order to capitalize on what we believed at the time were valuations that were not reflective of the underlying fundamentals. But in the end, we stayed true to the process that we put in place. We put careful considerations surrounding the risk involved before buying ultimately a structured product that was linked to European banks, that would create us a very calculated position that had an asymmetric return that worked in our favor. And I think a good testament to the strength of our research was when something unexpected like Credit Suisse, one of the biggest European banks that is out there, also failed. But I think when you look at it on balance, after all the volatility subsided and the dust sort of settled, both our positions, not only the structured product, but the also fixed income manager that we bought after the initial dip, has also recovered quite strongly. Yeah, so I think as active investors, being able to maintain that discipline to stick to the process and not being tempted to react all the time despite some negative outcomes, I think is a key attribute to have that will hopefully be rewarding for the portfolios over time.
Brilliant, thanks Nathan. And Scott, with hindsight, if you could do anything differently, what would it be?
Yeah, hindsight's a wonderful thing, isn't it? Probably, if we have one regret, it's around the equity market positioning. We've talked about at the beginning about how fast interest rates rose. We really didn't anticipate them going up that fast, and what that meant was that our equity positioning didn't have time to grow into its valuation. And I know that can be a confusing concept, but if you buy a company on the expectation of its growth, then you really need time for it to grow into that. And if interest rates are rising faster than the company can grow, then valuations have to go down, and that's basically what we saw. We just didn't anticipate that happening. And particularly around the end of 2021, we felt that we got the risk calls right. We were worried about valuations, large cap valuations, but where we went was sort of down the market cap spectrum into smaller companies, and that interest rate and valuation risk very quickly pivoted into recession risk. And you don't really want to be in the slightly more economically sensitive parts of the market, which is what small caps generally are. So it was one of them where we felt like we had some of the calls right, but we just didn't really get the positioning off the back of it right. So if I could change one thing, that would probably we probably waited maybe 4 months longer before we took that positioning, and we would have been a lot better off for it. Having said all that, again, the positions that we took, the managers that we bought, actually did generally a good job for us. So our selection was okay. We probably just got some of the calls on areas of the market within equities a little bit wrong. And if we could have a complete do-over, then that's probably the one thing that I would maybe go back and change, or whisper in my own ear, just give yourself another couple of months before you pull the trigger on that particular repositioning.
Brilliant, thank you. And what worked well?
Worked well, yeah. So this is a slightly more positive story, isn't it? Yeah. I mean, the bonds is the big one, and this is an area where again we were trying to manage risk. That's basically what we do. We knew with interest rates at record lows, there was a big risk inherent in the bond market because those interest rates had to go up at some point. Now, we don't claim any great foresight about how fast and how high interest rates went. As I said, we already basically got that call wrong on our equity positions, but we knew there was a risk there to be managed, and so we did manage that well by reducing our exposure to fixed income going into that period. And in a sense, tying the two hindsight sort of questions together, the fact that we protected better on the low risk portfolios where the risk was really inherent in bonds than we lost out on the equity position in the high risk portfolios showed that we probably on balance got that risk management right, even though in an ideal world we would have had our equity positions slightly better. So yeah, I think one of the things I often say is that we're basically risk managers, and I think when you look through a cycle, it's these big moments that you really want to avoid permanent loss of capital, a real bad downturn. Equity markets, we've not really seen that. It's been a pretty conventional downturn. Bonds, I think it was a bit of a one-off, a bit of a career thing, and so sidestepping a lot of that pain has been by far the biggest benefit for the funds, and certainly the one big positive that I will point to in terms of we did that really, really well, I think, looking back. And then just to finish, I guess, again on both, we always say in the team, it's in asset management, it's very easy to make money when you're right, because when you're right, things go up. It's very hard, or it's much harder not to lose money when you're wrong, and we have been wrong about various things over the past 3 years. Most people have. So I think it's a good sign that our risk discipline has kept us from accumulating too much losses on those things that we got wrong, and I think that really shows the robustness and the discipline within our process.
Brilliant, thanks Scott. And then lastly, just a brief 30-second note on your outlook for the funds.
Yeah, so I mean, again, forward looking, we're pretty positive. Obviously it's easy to say that given the sort of past 2-3 years we've just been through in terms of market returns, but if you look at the broad context of asset classes across the board, we have kind of reasonable to below average valuations. The macro context of interest rates are peaking, so we've got high but falling inflation. Combine that with valuations generally within a market cycle, this is a good point to be invested in the market. This is when taking that little bit of extra risk should pay off in terms of those long-term returns. And it's why we alluded to it in a recent quarterly video, I think, that we're much more leaning into the idea that I'm more worried about missing the rally than I am about sort of protecting a little bit more short-term pain. So generally it's been a tough 2 years, but looking forward, we're probably the most positive about the portfolios that we've been in almost the entire time since we launched them 3 years ago. Because we see a lot of those risks in the rearview mirror now rather than kind of ahead of us. And like I say, with the context of asset markets across the board, historically, this probably would have been a good point to invest in previous cycles as well.
Brilliant, thank you, Scott. Thank you for joining us today, Scott. Toby, Nathan, if you've got any questions about anything that we discussed today, then please speak to your financial planner. Otherwise, we'll see you next time.